Good evening, everyone. This is Henry Gambell with simpleroptions.com, and in today's free video I wanted to spend some time setting up Tesla with you. So it's currently about 2:40 p.m. We've got 20 minutes until the cash session closes, and I'm just going to be showing what I've got going on with it. Now, earnings to some degree are a coin flip anyway. You know, it's kind of like pick a side and trade that side. If you feel the opposing side of this trade, all you have to do is invert the strategy, play it the exact same way in the opposing direction, and obviously I don't have a bit of problem with that. I'm going to take the stance in Tesla that is a little bit more of a bearish chart. It's just the way that I'm looking to play it, based off the fact that the weekly squeeze has fired short. Now, I think it's fair to admit that we do have some action in both directions here. You can see that it's done a pretty good job of holding a major 618 retracement down here into 190, and then holding a much more minor 618 retracement as far as resistance goes. At the end of the day, I have two scenarios that I think could happen, one of which is we open neutral, right around 200. The other, and I guess I should say I have three, the other, of course, if it goes in my favor, anything lower, the strategies I share will benefit from that. The third part, and the other strategy that I wanted to share with you, is what if I'm dead wrong on this, and instead the underlying moves up to something like 210? Now that's the area that I would look for it to pause, but these are the three ways that I'm thinking of the chart, and it gives you a couple ideas of how I like to position for this. Two of the most common strategies that we're usually looking to around this, one of which is an unbalanced butterfly, and then the more basic side of that would just be your straight up short call spread. So, to compare the two strategies, we can come into our simulated trades in the risk profile, and the first one I want to look at is the difference between selling a vertical at 210, let's do both of these $2.50 wide, versus the idea of buying an unbalanced butterfly. So we put both of these into our risk profile graph, and it shows up a little bit better here on the visual side of it. I also like to come in and move to the nearest kind of round strike or the round numerical value so you can get an easy feel for what the math would mean on this. And what I continue to try and point out to people with these types of strategies is that if we're just looking at the short vertical, if this trade goes directly against us, we stand to lose $180. If you compare that to the unbalanced butterfly, looking at a very similar type situation where it explodes against us and we're just dead wrong, well, here we only lose $190. So it's still a very forgiving strategy in relationship to the risk reward. The other part that I think is so advantageous about this is with the unbalanced butterfly, if you do move up into 210 and say that's kind of where you hover, well then that yields a profit of $286 if you can pin there. Now admittedly, you're usually not going to get the pin, but anything in that range is still a very nice trade, whereas if you're dead right on just the vertical, the most you can make on this is the initial credit taken in of 70 cents. So I think that comparison, especially around earnings, when I'm trying to think, give yourself a risk in one direction only. Give yourself a strategy where you can make the most while you attempt to lose the very least. These are helpful ways to think about this as you head into earnings. And another way that I will look to modify this is moving this strike down into 195, moving the body back to 200, and then using the 205 as my other long strike. This is a more aggressive bearish strategy, but if we end up pinning at 200, which isn't far-fetched, I don't think, that's where we'll have the best results from that. Anything that rolls over, we'll take in the initial credit, which is going to be a little bit better, being there closer to at the money. And then, of course, if everything falls apart, you define your risk in the opposing direction. So I hope that gives you a couple of different ways to think about these types of reports. When Google reports tomorrow, I'll be looking to do the exact same thing with put options, giving myself no risk to the upside. So this is kind of how it's working out now. Some thoughts for movement into tomorrow, and hopefully you'll find that helpful as you begin comparing your strategies. So you guys have a great night, and I will see you at the next free video.